Good morning, Bowtie Nation. Thank you for joining us for another Monday Market Update, 9 a.m. Eastern every Monday morning. Get you ready for the week. Stocks to buy, economic trends, and the good news is good again, folks. After an initial sell-off on the idea that a strong economy would keep the Fed from cutting rates, the market reacted to a surprisingly good report Friday with higher stock prices. The bull market is here, and it could take some of those dogs in your portfolio higher. I asked all you out there in the Bowtie Nation, in our Facebook group, and on the Blossom app, what are your worst stocks that you still think could make great turnaround investments? I'm going to share 5 of the best stocks in yours and my portfolio for turnaround plays. Stick around after that. We'll do our Monday market update, everything you need to know about the stocks this week, which stocks I'm following, and the economic trends you need to see. But first, if you've ever wondered what's in my portfolio, or just wanted to see the stocks I'm buying, you can now by joining me on the Blossom social app. It's like Twitter, but for investors and without all the drama. The app was created by YouTuber Brandon Beavis for investors and by investors. I just started using this last year and love the app for getting ideas and sharing my portfolio with you out there in the community. And I know, not another social media app, but this one is much more than that. You can connect your brokerage accounts or just input your stock portfolio to track all your stocks in just one place. You're going to see insights like portfolio percentages, average dividend yield across the entire group. You're also going to be able to join more than 90,000 investors in the social feed to see what everyone is talking about. I've shared my portfolio on the app, and it's totally free to download, so look for that link I'm going to leave in the description below and check that out. Back to our main topic though, and Nation, we have all had disappointing stocks from time to time. Real dogs where it was either unexpected news or just being too early to that valuation story. It can be easy to get discouraged and dump those stocks, but sometimes those same dogs can turn out to be man's best friend. Case in point, I started buying Teva Pharmaceuticals in December of 2021 at $7.90 a share. The world's largest generic drug maker had gotten crushed over the previous 5 years under a mountain of debt and was getting hammered still in that opioid litigation, but I saw deep value at a price of less than half its peers on an earnings basis. The company still had strong cash flows and a pipeline of drugs, but the market just didn't see it my way. The shares would bounce higher on optimism every once in a while, but spent the next 3 years basically going nowhere. I was able to do well selling call options against the position when the price did spike, so collecting some of that cash and each time keeping the shares. But it's only recently with a spike past $12 a share that has produced this 56% return and the $71,000 upside to my portfolio. Another example here was in DraftKings, where I started buying in October 2022, just under $13 a share. Now, the stock had cratered along with all those other pandemic darlings, but I saw its dominance in that growing gambling market as close to a sure thing as you can get in Vegas. But the market kept betting that I'd crap out on this stock, continuing it lower to $10.69 by December. I continued to buy in though, building a 3,000 share position at an average cost of $12.35 each, and was able to collect a nice profit of $67,590 when I sold last November. On the other hand, sometimes those dogs just limp along though. I started buying Teladoc Health, ticker TDOC, in April of 2022, another one of those pandemic darlings that had fallen to $29 a share. I wasn't betting on a return to that pandemic high, but just that dominance in the growth market of virtual healthcare had me believing in this stock. I grew my positions to 2,000 shares at an average cost of $27.60 and waited. And growth slowed, and the stock seemed just like dead money. I finally cut my position down to 700 shares, selling just over 1,300 at its $17 a share late last year just to harvest some of those losses for my tax purposes. Now, with the rising tide of the bull market lifting all boats, I wanted to look again at some of those dogs in my portfolio and yours to see if they can learn some new tricks, and I found 5 that still look ready to run. First up is Alibaba Holdings, ticker BABA, the China e-commerce leader. And folks, if you don't like Chinese stocks, stick around because we're just getting started, but Baba is probably the one I feel the most confident about, and we could get some very big news when earnings are reported this Wednesday. The pain started in Alibaba before most of these, in 2020 when the Chinese government started cracking down on those internet giants, so sent those stocks really crashing lower. With the real estate crisis in the country, along with just a general economic slowdown, Alibaba fell to below its IPO price recently, an IPO that happened 10 years ago. But this company is still a growth name in e-commerce and has a lot of levers it can pull. It is a cash flow machine here, folks, generating over $25 billion in free cash flow a year, $10 billion of which it's using to buy back its shares, taking off about 3 or 4% of the shares off the market each year. Even in a slowdown on growth here, it's still expected to post 10% revenue growth this year and next, and the shares are trading for a ridiculously low, just 7.8 times this year's expected ratio, so 7.8 times PE ratio. By comparison, Amazon trades for 48 times its price to earnings. Now, why I'm so confident in Baba here still is because management has a fire under its ass to pick things up. Plus, we've got some surprising news lately that the market might not have realized that affects this stock. First, the company is exploring sales of many of its non-core businesses in retail, grocery, a lot of these other businesses it's put on over the years, a move that's going to lower costs and take Alibaba back to that pure play e-commerce stock that it should be. It's also got a lot of unrealized value in some of these separate business segments like logistics, cloud, and its Ant Financial Group, all three of which it's talked about spinning those off in IPOs or just selling those that could unlock a lot of value. Now, on the shorter term here, not only do I think management surprises with cost savings in that fourth quarter report this week, but if you look at the monster earnings we saw on Amazon and Microsoft last week, it was all growth in their cloud services from enterprise users scaling up in those AI testing. So using cloud services to test out AI programs, really boosting those cloud revenues for these companies. Now, Alibaba is the leader in Chinese cloud with 35% of the market and could surprise with that same upside this week. EV charging company Chargepoint Holdings, CHPT, has been a disaster lately, falling 84% just in the last year. I started buying in September and have averaged down to about $3 a share on this one. That's still down 33% on my investment. Even with the slowdown in EVs last year, though, a record 1.2 million cars were sold last year. That's a 50% increase from the year before, and we're still expecting EVs to gradually overtake combustion engine cars. Charging continues to be the big bottleneck here, folks, and the government is spending billions to incentivize a build-out of those stations. Now, Chargepoint is the market share leader by far here, and now has the advantage of being one of the first to receive FedRAMP approval, which was going to help it win a lot of those federal contracts. Now, this is another of those growth stocks that have lost some of that growth, with revenue expected up just 9% this year before 18% growth next year to $600 million. They recently sacked the CEO and CFO for being asleep at the wheel here, and I think that revenue growth surprises this year. As a new company, the cash flow here is a nightmare, burning about $350 million a year, but Chargepoint doesn't have any debt due until 2028. They are going to need to probably do a share sale or a debt issue this year and next to raise those funds, but they're not going to have any problem doing that with that growth. And the shares are trading at just 1.7 times on a price to sales basis, which for a growth company like this, folks, is very low. Should be closer to 3 or 4 times sales at least. WW International, ticker WW. I always still want to say Weight Watchers on that. The old Weight Watchers there was a turnaround play, more than doubled, and then it's back to being a turnaround play over the last year. I first started investing mid-2022 when the shares were around $6 each, sat in agony as they fell to a low of $3.46 early last year. I kept on buying on that strong brand and just a continued demand for weight loss apps, as well as just good cash flow and a balance sheet health on this business. I got my average cost down to about $5.60 a share on 15,000 shares, and it was up $86,000 when the company announced it was going to acquire Sequence and start offering those weight loss drugs as part of its weight loss management programs. But then Wall Street started worrying if that was going to be enough in October, and the stock began to fall. Then in December, Eli Lilly said it would start a direct-to-consumer delivery service of its drugs, and investors rushed out of Weight Watchers thinking people might just go directly to the drug maker. Now at $4 a share, the stock is back in value territory, and I think this sell-off is overdone. Tracking app downloads through SensorTrack, Morgan Stanley forecasted that downloads jumped 19% in the Christmas to New Year's period, and think the company is going to book 300,000 net subscribers for the fourth quarter to 4 million subs. Now we know the weight loss drug segment is popular and is a high-value market. I think the demand for these drugs is high enough that WW is even going to do well, even with that direct competition from the drug makers, so the direct-to-consumer sales as well. And 50% sell-off in this stock just seems overdone to me. We got to talk about it. Medical Properties Trust, ticker NPW. It's the toughest on the list. It's been the biggest disappointment and probably remains the biggest question mark still. The nation's largest owner of hospital real estate has gotten slammed on so many fronts here, folks. First, on the rise in interest rates, just hit all real estate, with commercial property stocks falling 25% in 2022 and just barely breaking even last year. The healthcare services industry has also been hit, first on that pandemic, where a lot of those high-profit surgeries and the elective procedures had to be postponed to triage those COVID cases. That meant a very low profitability for these hospitals, and as wages for staff just skyrocketed. Over the following years, insurance and Medicare reimbursements failed to keep up with the costs, and a lot of hospitals has just had to close down altogether. Now, those factors took the shares from $23 all the way down to $11 each through 2022, and a lot of those problems contributed to even a sharper drop over the last year. But Management is to blame here as well. NPW was dangerously exposed to just two tenants, its Steward Healthcare and Prospect Medical businesses, as these two hospitals operators have just struggled over the last 2 years. NPW has continued to extend loans to them, take equity in lieu of rents, and has just killed its cash flow. NPW cut its dividend last year, and it's not certain it won't have to do it again. Steward may file bankruptcy, and NPW has already said it would take a $350 million write-down on the rent and the loans it gave to that company. And while all this might sound like NPW is dead money at best, but there are 3 reasons why I think this still could be a strong turnaround candidate. We are at peak fear in these shares here, so if any one of these 3 things happens, if the company even survives, it could easily double over the next year or two. First is just the simple fact that NPW has over 444 hospitals worth more than $19 billion in the US and internationally. Management has sold some assets over the last year and has said that it's going to sell others to pay down its debt and just right this ship. There's also an interest rate story and a potential real estate rebound. Just as the Fed's fastest rate hikes in 40 years destroyed commercial property values, the reverse should start supporting real estate when the Fed starts cutting rates in just a few months here. We know that big money hedge funds and private equity are already fundraising hundreds of millions of dollars to jump in and buy at bargain prices on commercial property. It could go a long way in shoring up the balance sheet for NPW, meaning those higher property values, and just helping it to offload enough assets to stay out of danger. But the biggest one, the third catalyst here, one that the market clearly hasn't figured out yet, is the rebound in hospital services. Stocks of health insurers like United Health are falling off a cliff, reporting that medical costs have jumped just recently. Not only are prices for medical services going up, but the insurers are noticing a significant increase in procedures. Shares of United Health have fallen 7%. Humana has crashed 27% since November, while companies that run hospitals, including HCA Healthcare, that's up 22%, and Tenet Healthcare, 31%. Those stocks are booming. Now, that doesn't directly affect NPW or these hospital real estate owners, but it is going to support rents if hospitals are seeing that stronger profitability, and that's going to go a long way to improving the cash flows for NPW. Now, hospital property owners like NPW and Omega have continued to trend lower over the last few months, so it appears that Wall Street hasn't put this one and one together yet. PayPal, PYPL, if there is ever a bigger disappointment, I don't think I've seen it. I started investing late 2022 with this stock around $85 a share, another pandemic darling that had crashed from its peak. Looking at the company's dominance in digital payments, its Venmo digital wallet segment, it's just hard not to see the runaway value in this stock. PayPal has more than 430 million users, and Venmo has another 90 million on top of that, easily dominating that market share for its industry. And here, whereas MasterCard trades for 39 times on a price-to-earnings basis, PayPal is a steal at just 14 times earnings. But again, this stock has gone nowhere. Well, nowhere but down. Shares have sold off consistently to $50 each last October before rebounding on a change in management. The company kicked its CEO and CFO to the curb to bring in new blood. New CEO Alex Chris spent 19 years at Intuit, ending as the executive vice president of its small business and self-employed group. Now, Chris has promised to shock the market, and PayPal rolled out a suite of new features and AI plans last week, so we're hopeful about that. It also announced a 9% reduction in staff to help cut costs. Now, it's a step in the right direction, but it's also a big $67 billion company. I expect this one, it's going to take longer to rebound than some of these others on this list. Now, these aren't all the stocks in the Bowtie Nation is watching for a turnaround, so be sure to check out my post on that Blossom social investing app with the link below, see what everyone else is talking about. Now, I want to turn it over to some of the stocks I'm watching this week. First up, Healthpeak Properties, ticker PEAK. It's going to be reporting its earnings on Thursday and could be a preview into what we hear from Medical Properties Trust later on in the month. While Healthpeak isn't as focused on hospital properties as NPW, I'm hoping we hear some of that commentary from management on that state of hospital profitability and if those recent problems by the insurers have meant higher revenue for the servicers. If we do hear that hospitals and medical providers are doing better, but we don't see that bump in the shares of NPW. So in other words, we do see a confirmation that hospitals are doing better, but Wall Street still doesn't put that together and boost the shares for NPW. I'm going to be loading up for more shares ahead of their own earnings release. PayPal Holdings, ticker PYPL, also going to be reporting earnings Wednesday, though I'm not expecting the big turnaround or the shock that's promised by the new CEO there. The company rolled out plans for those AI features late last month and announced it would be cutting that 9% of its workforce. Both moves, again, are a step in the right direction to improve earnings and growth and remake this company and that goal of being a financial super app. Now, expectations for the valuation on PayPal are so low, though, that I think that any good news or even just an upgraded revenue forecast could be a good bump in the shares. It's going to take longer, though, for the company to convince investors to come back in full force. Big news of the week, though, probably going to be Alibaba Holdings, ticker BABA. It's going to be reporting its earnings on Wednesday, and as mentioned, I think this could be the big surprise of the week. This stock is deep in value territory, and any upside catalyst could send it higher. In those potential catalysts, we have cost cuts that could boost earnings for a surprise announcement, any announcement on segment sales or IPOs for these segments, or just a dramatic rise in that cloud business. I think that's the biggest potential here right there. Showing you that big picture idea here with the sectorspiders.com sector tracker, great free resource on the internet. We did see that 9 of the 11 stock sectors closed positive last week, with energy stocks falling on just a drop in crude prices, real estate stocks really suffering on that warning in office loans by NYCB. Now, with oil around $72 a barrel now, energy stocks are going to have more upward support and still benefit from those cash flows. So I do like energy stocks at this point. Real estate is likely going to suffer for a little bit longer as clouds hang over that property sector, but should improve quickly as the Fed starts cutting rates here in a few months. Consumer discretionary stocks are showing a real strength here as strong jobs numbers and wage growth keep consumer spending alive. Household credit isn't stretched by any means here, folks, and the group should continue to do well, especially as rates cuts lower the cost of borrowing through the year. Good example here, if we see in some of the hardest hit stocks, Etsy recently attracted activist attention, which could help turn that stock around. McDonald's could be ready to surprise the market with its earnings just this week as well. See all the stocks in my portfolio and that post on your best rebound stocks with the Blossom Social Investing app and the link below. Or click on the video to the right to see how to invest $1,000 in 2024, the stocks you won't want to miss. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.